As a multi-billionaire, what is the best way to invest your money? Is it in the public market or the private market? Is it invest in big funds or small funds? Is it invest in index funds or hand picking stocks? This is what this video is about. So if you've made a lot of money, this is a video for you. If you can imagine yourself making a lot of money in the future, this video is for you. But if you're not trying to be successful, this video is not for you. So you can click off. I do run a community of very successful entrepreneurs called Wellington. You have to at least be doing 500k AR or have raised £1 million. It's a very vetted community of real entrepreneurs. It's not easy to get into, you have to apply into it. But if you believe you're a winner, you're a freak, you're a killer, click the link in the description and I would love to have a conversation with you and see if we both align and if you can fit into this high vetted group of entrepreneurs. Investing is a common word thrown around within my community in Wellington. If you don't know, I run a community of very successful entrepreneurs who do at least 500k a year AR or who have raised £1 million in funding. I've researched, read, spoken to, or listened to hundreds of successful entrepreneurs. If not all of them have a large amount of their net worth held up in investment funds or in investment. The main purpose of this video is to dissect the difference between angel investing or VC investing in comparison to picking the stocks yourself. So if you're familiar with the power law, the job of an investor is to find the power law winners, which means it's not to buy the index. This conversation always varies between people who prefer SP 500 or people who prefer buying specific companies. In my opinion, when you buy the venture index, the upside is so capped, like significantly capped, in comparison to buying individual stocks. Then people are going to say, what about the amount of time, the amount of research, the amount of effort it takes to pick the correct stock, the amount of insight? Yes, most of these successful people have a little bit of inside knowledge. But I think it's a lot easier than you think it is. If you look at the S&P 500, majority of its weight is improportionally distributed to around 7 stocks. So this is why the name Mag 7 even exists. I don't really like this graph, but there's a graph of the top decline IRR in smaller funds tends to be higher. And it shows that the smaller the fund, the less diversified it is, which means the more they're likely to capture the winners, which you can infer the smaller funds tend to have better returns compared to bigger funds. Why is this? Because smaller funds has less capital to allocate and have to be a little bit more laser focused to get similar or better returns than these bigger funds. And then if you double click into these smaller funds, what do? They only invest into a handful of stocks compared to all these bigger funds who hold a little bit of SP 500 and have a large amount of stocks that they're holding. A side note, smaller funds are to get into these massive companies a lot earlier than these bigger funds. Let's take that into consideration. And they're paying lower valuation. My main point is they're not getting diluted away by the index. They are not, because they don't have the capital to do that. The power law really, really matters. Your job is just to find winners. And when you find the winners, the upside is significant, extremely significant. And these winners always compound. They always compound. I'll try my best to upload it here. If not, just listen to me. I have a 2023 Gakul Roger published graph, which was first published on Twitter. It basically shows the years elapsed in comparison to the multiple. The main conclusion of this graph is, if you buy the top 10 companies in the NASDAQ, and if you just hold them, your returns in terms of your multiple is significantly higher compared to the S&P. You would have made a 24 multiple over a 24-year period. That is absurd. That's not heard of. That's not normal. This is why it's so important just to pick top companies. Yes, you can look for a small company and try to 20x or 25x or even 80x your investment. However, if you just narrow it down to top 7 companies and you pick a handful of them, your multiple in the long run would be crazy. It'll be so mind boggling. So, the best way to drive multiple return is just owning the best companies in the NASDAQ. It's so much easier than people figures. I don't know why people love to overcomplicate stuff. Not everything needs to be overcomplicated. Not everything, in my humble opinion. A 5x multiple in 7 years by just not doing anything stupid, just owning the top companies in NASDAQ. That's all you're doing. You're not even doing additional research. That's how easy I think this game of investing is. And investing is very important for wealth preservation. Yes, you can use it for wealth generation, but mainly for wealth preservation. I saw this last figure from the podcast All In. It's such an amazing podcast. I would highly recommend it. It shows that ventures returns don't stop when you're being a private company. So if you look, for example, Palantir, the market cap at IPO was 16 billion. In 17 years from funding to IPO, the market cap went to 55 billion. Are you understanding that? From 16 billion at IPO to right now 2025, 55 billion. So since Palantir has been public in 5 years, they're now worth 463 billion. This just shows that you can get so much value after IPO. So much returns after IPO. How have Palantir created 420 billion of equity after market cap? It's doable in just 5 years. This is also an anomaly because this literally eclipsed all venture returns that have been made in that same amount of time period. All of them. By just picking one company called Palantir. And I'm not saying you have to be early on, because this is after they've IPO'd. Come on. In 5 years. I don't know how easy to say this. You just need to pick the best companies by just picking the top 5 companies in the S&P 500. That's all you have to do. And just hold it. Airbnb had a market cap at IPO of 47 billion. Just roughly after 5 years, they made around 30 billion. 30 billion in 5 years in the market cap is crazy. So you don't always need to be early when it comes to investing. Neither do you need to pick the S&P 500. But you can just pick top 4 companies in the S&P 500 and just hold it. And you make so much more returns with your money. Bear in mind, majority of venture capitals make their money by management fees or referral fees or whatever fees they charge you. That's how they make most of their money. So you're paying a fee for people to manage your money when you could just hold these stocks. Most of the holdings are online anyway, it's all public. Why are you giving your money to other people who are meant to be better than you, but the majority of them are holding the S&P 500, especially if they're a larger fund? Shopify, after IPO, was at 1.27 billion. This was 11 years from funding to IPO. Then since IPO, in the space of 10 years, they went to 94 billion. In 10 years, it went from 1.7 billion to 94 billion. It's crazy returns. Crazy returns. You can believe in Shopify for the first 5 years. The market would have still been up by another 30, 40 billion in 5 years. If that. This is all self-explanatory. You just need to pick the power low companies. That's all you need to do. As most billionaires say, when you're in the venture capital market, you do learn a lot. However, that's not where the big returns are. I'm telling you, most people lose money from venture capital. They lose a lot of money. And they lose a lot of time compared to just picking stocks and investing most of your money you've made from your exit or your cash flow business into that. Yes, it may not be easy to identify these power low winners. Maybe you just need to follow the crowd. What is popular? for the last 5 years? What are the top 10 companies that every single fund is holding? And just invest it and just wait. That power law compounding is a real thing. That's a ninth wonder of the world. Compound interest, or 7th or 6th, wherever it is, was up there. Yes, you invest in the private market, but I'm telling you, all these companies that IPO, they IPO'd for a reason. They are not stupid. They're highly intelligent, highly observed. They have reasons for everything. A majority of them, once they IPO, if they're a really good company, and then they're added to the S&P 500, top 10 of the S&P 500, they're there for a reason. A majority of them stay there for a long time. So just hold your money and put it into a top 7 company. That's all you have to do. Forget this venture capital. It doesn't work. It's so hard to win that game. It's so hard. Venture capital investing is so hard. I don't know if you guys understand. Yes, you may want to try, learn about entrepreneurs, learn about people, learn about working in a team, learn about business. But in the long run, it's a waste of money. Obviously, I don't 100% agree with this graph. I don't think this graph is extremely accurate. It's because he cherry picked these companies. If you picked all the tech companies, it wouldn't be this smooth. However, there's this famous saying, let the winners ride. Your winners, just keep investing. Just let them keep going. Just let them ride. Don't do anything absurd. Just let them do that. Let them do their jobs. That's what they do. There's this great investor called Roelof. I rate his theory of have a little bit of private, have a little bit of public. That's the best way. A little bit of private companies, a little bit of public companies. And then you will have the best of both worlds. Disclaimer. I'm not saying picking these companies are just easy by just let a company goes on IPO and just cherry pick and just be able to pick them. I'm not saying it's easy. No, it's extremely hard. That's why a lot of people lose money. But once you find these power law companies, just let them ride. That's all I'm basically trying to say. They don't need to always invest in the index. And I think that's a lot better in comparison to venture capital. One of the key things that Chamath said about venture is it is so good for the people who are in it to gather information about businesses and then build a business around the information gathered from venture capital investing. That's very important. That's one thing I cannot disagree with. You can monetize that. However, if you're not trying to monetize that, just build an asset machine that makes money. A business. This is why I'm for people making real generational business, legacy business, businesses that will last decades and generations. It is so vital. This is the only way to win the game. It's the only way to win the game. Trust me.